Hi, I'm Barbara Friedberg here today with Brian Barnes, the founder and CEO of M1 Finance, a very unique financial platform, and also the recent owner of B2 Bank as well. So Brian must never sleep because he graduated from Stanford, a little over 10 years ago, started M1 Finance, a very, very popular and unique financial platform, has grown that to enormous size. Company has raised over $325 million, recently valued at 1.45 billion. I don't know what you've been doing for the last 10 years, but I will tell you, I can't compete with that. So, Brian, welcome. We're going to start off by asking you to tell us just a little bit about how you got started. And I want you to include for us something that you don't tell most of the people that interview you, because you've been interviewed quite a bit.
Yeah, well, very much appreciate you having me. Thanks for the great introduction. So, a lot of the pertinent details for starting M1 really did start from quite a young age. That was introduced to finance and investing quite young and sort of coincided with a school project where we had to do a presentation on a company, got a fake $100,000 to invest in this, competition amongst the school. And at the same time, my parents said, hey, if this interests you, we can do it, give you access to a real brokerage account. You have to pre-clear every trade through us. You have to go through your ideas, but we'll do it with real money. And just from a young age, you give me this intellectual puzzle and have money attached to it, and I was absolutely hooked. And so just sort of devoured everything, every book that there was on investing, and did it under the guidance of my parents, and really developed a natural fluency with financial topics as a result. So I was personal finance nerd from a young age. Did the undergrad at Stanford, so your belly of the beast of Silicon Valley, seeing companies go from an idea to something quite a bit larger in a short amount of time. It's funny, while I was there, I wanted absolutely nothing to do with startups. At the time, I thought they might be a little pretentious, these founders, and I probably still think that, maybe myself included. But yeah, started the company almost 10 years ago now. Really trying to create the personal finance platform that I wish existed in the marketplace that I didn't see being created. And so we focus across a whole bunch of different domains, but I'd say our universal principles are personalization and automation, and then trying to give the best rates associated with that. So we're in our idealized fashion, we talk about it as digitizing the private bank experience. And so the private bank is the best that finance has to offer, but the unfortunate scenario is you have to have a few $100 million to work with them. And so, how can we provide many of the same tools, access rates, personalization, and the sort of like throw it over the wall and have something, some in the private bank world, it's someone doing it for you, but in the M1 world, it's having software do it for you. So that has been the journey over the last like 8.5, 9 years now. It's been up and down and everything in between, but generally on the upswing, which has been a fun ride. I didn't include anything. I'm trying to think of things that I don't normally tell people. I'd say, uh, I'm a finance geek. I have a relatively like conservative personality in terms of all things money related, and sort of even keel personality. But I do have like, I very much enjoy motorcycles. I have a private pilot's license, and so it's fly little tin can with wings. And so am more risk tolerant in the, I don't know, outside of work and finance realm than I probably am inside of it.
Wow. Well, I appreciate that little tidbit. And the next time you get in your plane and you head over to Silicon Valley, you must visit me. So,
I I will commit
gotta
to
be a
that promise.
promise.
Yeah.
Okay. So, for those of you that don't know what M1 is, M1 Finance is, and how it works, and I want to give a disclosure here because I am invested in M1. I have some money with that platform, and I'm also affiliate. So if you do sign up for the platform with a link listed below, my company might get a small commission. So with that out of the way, Tell us the nuts and bolts, and why should someone go with M1 Finance versus, just open up a trading account at Schwab?
Um, yeah, so we are really a holistic digital wealth platform. So we created a comprehensive platform with a whole bunch of different products and tools underneath it, really with the sole goal of helping the individual investor, the individual person managing their own finances, um, build and manage their wealth is the ultimate goal. We do that across four main verticals. And so the first is Earn. And so that's a place, we have a brokerage cash account and a high yield savings account in there, but it's a high interest rate deposit account where you earn 5% on your money and you can sort of do anything that you would normally do out of a checking or savings account. We then have a product pillar Invest, which is what we started with and what we're best known for. And versus the traditional online brokerage, uh, every online brokerage is really built around stock trading. And so, as a result, it orients towards that. It wants you to buy at 10 a.m., sell at 2 p.m., or buy on Monday, sell at Thursday. M1 is really built towards automated portfolio management. And so it takes a much longer time horizon and saying, you're trying to invest in these underlying ETFs and securities and companies for the ownership stake rather than the price movement. And so it flips the trade on its head and said, instead of placing trades, build your portfolio and automate that portfolio. And so, people are making portfolio decisions less frequently than they're making trading decisions. And so it's really saying, tell us what you want to own on a percentage basis. In that way, it doesn't matter whether you have $100 on the platform or $100,000 on the platform. It all acts the same and allocates to the portfolio as a whole. And we dynamically adjust where the money goes based on how the portfolio has performed relative to the target allocation. So, versus a Schwab, Schwab's very much a trading platform. Some people use that trading platform to enact an investment portfolio. M1 is just much more in the maintain an investment portfolio. And we do have a lot of tools and features and functionality to implement that in a more intuitive way. And, some people call us like a fully customizable robo-advisor. So we take the automation of a robo-advisor, but you can invest in any stock or ETF that you want. So
You
that's Earn and Invest. We also have a platform, Spend, which is a high cashback credit card. Starts at a baseline 1.5% cash back. And then there are different merchants where you can get higher rewards up to 10%. So if you put your Netflix subscription on it, you get 10% cash back. That can flow into your Earn account. That can flow into your Invest account, wherever it may be. And then we have a pillar called Borrow, which currently is brokerage margin, where you can invest using your portfolio as collateral at very low interest rates, very flexible terms. And then we have unsecured lending, where you can take out personal loans, and that's amortized over periods of time. And we'll sort of fill in that bucket of secured lending over periods of time. But so we have all four of those main products, and then basically an automation suite on top of it. So anytime a dollar comes into the M1 platform, it just gets routed towards where it can be best used in your sort of comprehensive financial picture. So, generally speaking, you tell us, this is how I want to manage my finances. You create and construct a plan for it. And then anytime a dollar comes in or out, it's automatically allocated according to that plan until you come in and tell us to do differently.
I think you've done this before because that was a great overview. Now,
I have had to do this once or twice. So
now your margin loans are tied to the amount that's in your account. Is that correct? There's a certain percentage that you can borrow off of that. Is that correct?
that is correct. And
Okay.
I think it's twofold is there are regulatory parameters around what we're able to do. And so we go as much as we're allowed to do on a regulatory basis, which says we can basically give you, for every dollar you put on the platform, we can give you 50 cents as a margin balance. Or if you keep it on platform, we can give you another dollar. So we can sort of do 2-to-1 leverage on the initial thing. And then there are parameters that we have to manage, based on how the portfolio is doing. But we, allow it to the full extent that we're allowed to do on a regulatory basis.
And then what about the loans? Is there a limit on the amount that someone can borrow through the unsecured loans? And, how do your rates compare with competitors for the
Yep.
loans?
So the loans are anywhere from $2,500 all the way up to $50,000. They can go in terms as short as 2 years or as long as 7 years, and different terms that people select in that dictate the rates. Generally speaking, we compare our rates to every other bank or big fintech company offering personal loans, and We are consistently, I can't say the lowest at all times because compliance will yell at me, but amongst the lowest, beat the vast majority of players out there. And I think it really does get into when we're able to offer a comprehensive platform and manage your money based on the totality of the relationship. We're not in a position where we have to make the full extent of our money based on one product. So, if you go to an upstart, that's the only product that they have. They need to make all their money. They acquire after you pay off your loan, you may be gone forever. M1 is really looking at this of you need to manage your money for the next 10, 20, 30, 50 years. And we want to be able to offer you financial service products over your entire lifetime. And so it allows us to say, we're going to compress what we make on any given product. We're going to offer you a comprehensive suite. We're going to offer you a robust platform across all of your financial needs. And so it allows us to offer really best-in-class rates across each one of our verticals.
I am impressed with how succinctly you shared that information. And it reminds me of my favorite M1 product, which is called your model portfolios. And those are groups of investments that are put together. And I want to ask you, first of all, they're categorized into about 8 different categories, from things like retirement to dividends to other categories, and you can elaborate on those. But who did you get to put those together for you? And can you give our listeners an idea of why they might be interested in a model portfolio if you are a beginning, intermediate, or even sophisticated investor?
Yeah. So I will let me know if I don't hit on all of those questions. But broadly speaking, we say it all the time internally that personal finance is personal, and so every single person comes to M1 and even just generally approaches their life where they make money in a different way, and how much they make is different. What they want to spend it on is very different. When they have excess, what their risk tolerance is, their perspective of the world, how comfortable they feel with debt, where they start to get, a little bit nervous on taking too much, how they think about, giving money to their kids or being philanthropic. So broadly speaking, we just look at it as every single person needs to have a unique, custom, personalized plan to their heart's content. The issue with that is some people don't want to make this their day job, managing their own finances. They have better things to do. They want to go about it, but we do feel like there's a benefit in sort of general participation. And so the way that we've oriented the platform is we say, you can have as much personalization as you feel comfortable having. And if you're not sure where to start, we will get you started with a, very good option. We'll try to put forth a 95% option for you to just grab off the shelf where you don't have to think about it, and you get a very good, like, world-class investment portfolio for no cost. And so that's really where the model portfolios come into play, that we have those 8 different categories. Some are built around just general investing on a risk tolerance. Some are built around retirement, where they become more conservative as time goes on. Some are built around specific industries or specific objectives in what you're trying to achieve. And all of these, based on the response, you can use it for the totality of your portfolio. You can use it for the predominant aspect of your portfolio. So you can say, I want this to be 95% of my portfolio, but 5% I want to, just have fun money with 6 stocks that I enjoy following, and it makes me feel, listen to the markets a bit more, get more comfortable with finances, get comfort with making investment selections where, it's not going to make your finances, but it's also not going to break your finances. And so, we allow for these model portfolios to get you to just having if you were to do that and nothing else, you still have a world-class portfolio. And this is, thanks to general index investing and sort of modern portfolio theory and sort of all the thought that has gone into diversification across asset classes, across time, and minimizing costs, and sort of following the index and average really gets you to a good place. The average with lower fees is going to beat the average with high fees, is sort of the general principle of index investing. In terms of how we construct that, it's a wide range of, we have internal expertise on staff, general CFAs that put things together. We use market cap weighting based on industries and things like that. So really depending on the portfolio type, it sort of it comes from some level of expertise, whether we have that internally or are outsourcing that to some external expert.
Great. Yeah. I happen to have what I did with the model portfolios was like just a little kind of experiment. And I put 50% in a dividend income portfolio, a global dividend income portfolio, which happened to be all stocks, but higher dividend stocks. And then I put 50% in a 60-40 stock and bond portfolio. And obviously, one would think the stock portfolio would outperform the 60-40 stock bond portfolio. And for many periods it has, but I think I've been in the platform with these two pies, and I'm going to I mean, these two pie slices, and I'm going to ask you to explain those. And what I found was they performed virtually identically over time, which was, it was pretty interesting. So comment on that, and also tell our listeners what is a pie, because if you look into M1, you're going to learn about pies.
Yep. So the performance, I think the challenging thing with investing is, you're trying to predict the future. And so if everybody knew for certain what would happen, you would just pick the things that always worked. And the thing that you learn in investing very quickly is the future is incredibly hard to predict, and nobody is absolutely certain about anything. And so that's why, people are constantly trying, in the ideal scenario, the price of any financial asset now reflects how it's going to do into the future, and you're discounting cash flows back to present day. You see with the volatility that happens in a day-to-day basis, we're not that accurate in predicting what it should be. And 3 months from now, something catastrophic happens, or interest rates change, and we have to blow up the model and say things are valued very differently. And so it really does get into a risk allocation of, you don't want to put all your eggs in one basket, so to speak, because if something bad were to happen to that basket, that is completely out of your control. You put it all in even one stable dividends, paying stock, and I don't know, some magical technology breakthrough happens where that becomes no longer a stable company, or the government regulations change and their business is no longer viable in the same way. Big catastrophic things that are insanely difficult to foresee can really swing an individual investment or a single choice that you make. And so that is where there is benefit of diversification, of even things that are correlated. You get benefit by spreading your money out a little bit, so you're not exposed to any one given sort of peculiar risk to a certain investment. That is really how we've built M1. So we build it around pies, and we call them pies. I don't know if we're the most creative in branding, but because they're pie charts. And so it's really to make your portfolio visual and more understandable than just a line or a transaction list of securities. And so really what we're trying to do is say, instead of saying, I want to make this transaction in stock, and it's this many shares, and it's this order type, and it's this price per share, which doesn't really have any significance because it's all about market cap or enterprise value. Really think of it more as, you have 100% of your money to put to work. What percentage of your money do you want in certain investments or categories of investments? And that's where you start with the totality of the pie, and you start creating slices. So you can say, I want 5% of my money or 5% of my investment portfolio to be driven by this individual security. Or you can say, I want 40% of my portfolio's value to be driven by this collection of securities. And so that's the example that you gave of, you've split it 50-50 and said, I want half my portfolio to be driven by this collection and half of my portfolio to be driven by that collection. And then what we're doing is, anytime money comes into the platform, we are, if you do it the first time, allocating it perfectly down to the penny of what should go into those securities. The issue that you get is, over time, those investments may change based on relative performance, where one slice of your portfolio, you want it to be 5%, but it outperforms, and so now it's 10%. So now it's actually driving more of your portfolio or investment performance than you've indicated that you wanted to. And so as money comes into the platform, we're going to not allocate as much money into that slice. We're going to allocate it into underwhite slices to basically bring it back into balance and get into this position where the risk of your portfolio is driven by your allocation decisions. And so it's a really intuitive way to construct and organize your portfolio. It allows you to say, I want this percentage of my portfolio to be driven by this selection of investments. It also sort of mandates and forces this rebalancing nature where as things underperform and get relatively cheaper, you add more money to it. And as things get relatively more expensive, you don't continue to add money to it. And so it dynamically rebalances your portfolio in a very tax efficient way to really keep you towards the target allocation that you're trying to maintain.
That is actually one of my favorite features of M1 because I am a former portfolio manager and obviously I do a lot of rebalancing. And for the average person, it's not easy and it's not fun. And so even if you are someone that likes investing, it's nice to have someone do the rebalancing for you because it instills a certain level of discipline. Okay, I have one final question before we wrap it up. And well, maybe two. Okay. What are the fees?
So generally incredibly low. So if you have more than $10,000 on the platform, it's 100% free. So, we don't charge for earn account, the invest account, the spend account, or the borrow account sort of excess or like independent of the interest that we charge on the amount that you borrow. If you have less than $10,000, it's $3 a month, so $36 a year. And if you ever tip above $10,000 in the course of the month, you get the platform for free for that month. So there's a little bit of, $3 a month for those sub 10,000, 100% free for those that are below 10,000. Finance is a little bit weird where fees are both explicitly what you pay, but it's also what you earn. And so, the fact that we offer 5% in our earn account, if you're using, I'll throw Chase under the bus, like, Chase in their savings account is paying probably 0.01%. And so the delta between that and 5% will round up and just call it exactly 5%. For JP Morgan Chase's savings account, you're basically paying 5% every year to manage your money in that account. So if you have $10,000, you're paying $500 a year by using them rather than a platform like M1. You're just not seeing it in an explicit fee that you charge. And so the fact that we offer higher rates on our earn, we offer free investing, in the spend, it's one of the highest cashback credit cards on the market. In borrowing, it's some of the lowest fees out there. That margin is at Fed funds +2. So, for a while that was 2%. It's gone up as a result of Fed funds, but as Fed funds comes down, we will be lowering our rate. I would say it is a combination of insanely low fees that you pay explicitly, as well as best in class rates that you earn on the products, as well as low rates that we charge on things like borrowing.
Brian, I'm going to trip you up for a second because the 5% that you earn on your spend account is awesome. But let our listeners know what's going to happen to that 5% so they understand how that amount is determined should the Fed lower interest rates.
Yep. So we do. The Federal Reserve is sort of the central bank of the United States, and they set what's called the overnight Fed funds rate, which is the rate that banks can borrow from the Fed. And so it really does set, you can think of interest rates as like the price of money, and it's sort of the input, when people buy homes and build homes, their input price is the price of lumber. For banks, like the price of money is really driven by this overnight rate. And so, from 2009 to basically 2020 with a small exception of time, Fed funds was close to zero. And so, that allowed for very low interest rates, but no yield on cash balance. In the last 18 months, we've gone from close to zero to about 5.25%. And that really is what determines the ability for us to pay 5% on that money. The very likely scenario is the Fed has indicated that they're going to be reducing rates, and sort of there's, it is insanely difficult to predict predict or project what's happening with interest rates over time, but the market is assuming and the Fed is indicating that it will go from 5% down to 3% over the next 1 or 2 years. That is, if you are perfect at estimating that, you're a hedge fund billionaire. And so it's, I will put every caveat in front of that of it's very hard to predict what's happening with short-term interest rates. And M1 will match what really happens with the Fed, that, if the overnight rate is closer to 3%, that's closer to the rate that we will be paying on the balance. I think the big difference is, most of these banks locked people in at 0%. And then as they started earning 5% on overnight balances, they didn't budge because they viewed it as that was their money to earn, not you. I think M1 takes the position of it's your money. There's a going rate for cash. We're always going to try to provide what you really deserve on your cash, which is, changing on a dynamic basis. And we're not going to be in this business of trying to lock in your money and pay you a significantly below market interest rate on your cash, where it's your cash. You should be earning the full market rate on it.
What else do our listeners need to know about M1 and about you before we wrap up?
So you mentioned it in the beginning. So M1 is this fintech company. We started in the brokerage space and built up investing. A very weird opportunity came up where I, as an individual, could buy a bank. And so bought this small bank up in northern Minnesota, rebranded it B2 Bank, like these letter number names for companies. And the nice thing is that provides us a foundation to provide a lot of banking services as well at very, value-oriented rates and pricing and the like. And so it really does, there are two separate entities, but by working together through a partnership, it really does allow us to offer the best of digital investing and digital brokerage, as well as all things digital banking. And we will be continuing to expand the suite of brokerage and banking products. And so, it really is M1 started on investing, but has systematically chipped away at trying to create this comprehensive, holistic digital bank, digital finance platform, and really offer the best that digital finance has to offer.
You must be a mind reader. I was just going to ask you about the new products in the pipeline. So answered that. And for all our listeners out there, I have done a video on the pros and cons of M1. So obviously it is a very robust platform, but we like to be balanced. So if you would like to learn more, I'll put a link to that video below. We'll have links to the platform and other resources that will help you learn more about M1 and investing as well. Brian, it was such a pleasure talking with you, and I so appreciate you showing up today. Thank you.
Absolutely. No, thanks for having me.
Great. Well, we will see you next time. And if you like this show, please give it a thumbs up and subscribe. Bye-bye.